Hello, ladies and gentlemen. Hey, this is Dean Barwick, your host for the Money Talk Show. Hey, listen, we've got a short but very important segment we're doing today. Today's segment is on the how to avoid the 12 most common IRA and legacy planning mistakes. And today we're doing how to avoid mistake number 7 in the series of IRA and legacy planning mistakes. So before we get started, let me introduce myself again and our company. I am Dean Barwick, the president and founder of Acquire Capital Management. We are a registered investment advisory firm here in the state of California, and we do all of our broadcasting through the Money Talk Show. And of course, they broadcast all over the world, but we're really concerned about the 50 United States. And they do that through the internet, of course. So if you're in any of the 50 United States and you're saying, hey, Dean, I'd like to hear more about what you're talking about, or talk to somebody in my area that can help us out, go to the Money Talk Show and they will get you set up with a great advisor referral program. Okay, well, let's take a look at this. In mistake number 7 of how to avoid the 12 most common IRA and legacy planning mistakes, number 7 mistake is failing to take the required minimum distributions from your IRA. And that would be also called your RMD, required minimum distribution. Now, this kind of goes hand in hand with mistake number 10 we did last week, which is having too many retirement accounts. And we'll go into that a little bit later. But let's go ahead and proceed with this. You know, if an owner of a qualified plan, and a qualified plan, that's your IRA, your SEP IRA, any of these plans that give you tax deferral and tax deductions for putting it in their qualified plan, any of these plans, if you own one and you fail to take the required minimum distribution, could be absolutely disastrous. Any owner that fails to take the required minimum distribution in full is subject to a 50% excise tax on the undistributed portion. That's a tongue twister right there. Anyway, that could be a lot of money. If you don't take out as much as you're supposed to take out for that year, hey, you could have a pretty heavy duty penalty owed to the IRS. So let's go ahead and take a look. By the way, that comes under IRS publication 590. So if you do want to look that up, I encourage you to do so. Let's go ahead and move to the next slide. You know, in this example, basically failing to take the required minimum distribution. Let's say you had a 15,000 missed required distribution. In other words, you may have taken half of it out or a portion of it out, but you didn't take the full amount out, and what you left in was $15,000. So there's going to be an excise tax on that missed distribution of 50%. So that's $7,500. Excuse me. And then you have your $4,500 income tax on the distribution at 30% tax bracket. That comes out to a $12,000 total tax and penalty. You know, 80% belongs to the IRS because you didn't have a formal distribution plan. And let me just take this again to get on my soapbox and say why it is so important to work with a fee-based financial advisor, registered investment advisor, certified financial planner, somebody who is fee-based, who has your best interest at heart, who can set you up with a plan that not just for saving the money, not just for investing the money and getting you where you need to go in retirement, but once you're in retirement, for managing and maintaining your financial security while you're in retirement as well. And that brings me to a great point. Move to the next slide. You know, my clients take their required minimum distributions. We use a very sophisticated software to run consolidated statements. Now, our statements include the RMD, or the required minimum distribution calculations for all of our clients, alerting us 60 days prior to the distribution date. Now, if you'd like to work with a financial advisor that offers this type of service, go to the Money Talk Show, and they'll be happy to get you set up with that. We'd be happy to help you if you are in California, but it's very important that you're working with somebody because you've spent so much of your hard-earned effort, of your good discipline to save money, to invest it wisely, to work a good, stable financial plan to get you into retirement. Now you want to enjoy your life. You've got to have planning in this stage every bit as much, and I would even say more so than the stage that got you here. You've got to know what you're doing. You've got to be very careful. It's not the time of life to make huge mistakes and try to recoup that. So that's my soapbox on that. We recommend going to the Money Talk Show. Got a great advisor referral program. Go to the Ask a Question if you have any more questions on the required minimum distribution, and they'll get back with you, answer those right away as well. And of course, the Money Talk Show offers financial workshops all across the United States, and I recommend that's something that you might want to take advantage of as well. Anyway, so mistake number 7 is failing to take the required minimum distributions. The way you get around that is you work with an advisor who has a software setup that will keep it, that'll automate it, that'll give you plenty of notice in advance so you don't find yourself in that type of a situation. Hey, this is Dean Barwick for the Money Talk Show saying goodbye till next time, and we will talk to you soon. Bye-bye now.